Good evening, everyone. I hope my voice is audible to all of you. May I get a quick confirmation over the YouTube chat box. So we've started 10 minutes late and I announced it on the WhatsApp groups as well. So if you're not part of the free WhatsApp groups, make sure you check out any random description on my YouTube channel. You will find the link to join the SBR Global Group. So I hope I'm audible to all of you loud and clear. Awesome, awesome. Okay, great. So welcome you all to the SBR Grand Revision for December 2024 attempt. And I hope everyone have been doing really well these days and you have completed your syllabus up to certain extent that you are confident on almost every standard. Now in SBR, it's always like, we feel like there's a lot of syllabus and it's always feeling like things are going out of our hands, just like you hold sand and it always flows out of your hand. That's what you feel with SBR syllabus. Just let me know if that's true because that used to happen to me. And even still, when like I was preparing for your grand revision and I was going through the standards and it was a very lengthy syllabus. Now, if I talk about SBR, it's not important that you should know every standard in minute details. But you should know every standard. That means if anything comes up out of any random accounting standard, you should have the knowledge that, okay, what's happening here? What is to be written? What should be my answer to this? You should have that much knowledge. So today in this session, I'm going to cover very important accounting standards with you. I'm not saying I'm going to cover the whole accounting standards. I will miss out on few small accounting standards like, I-33, operating segments. All these are very small and very less marks are allocated to them. But I will cover the major aspect of it. Now, if I say whether FR students should join this as well, yes. Even the FR students must join this. The first part of my grand revision will be just for the FR students. Okay. So SBR includes the syllabus of FR. So first I will revise the FR syllabus and then I'll move on to the SBR syllabus, right? So today we are going to make our own notes on the Word file and after the session, I will share these notes with you. In the description box, I will attach the link to that document. You all are supposed to just, listen to me, not write anything, but just listen to whatever I say. Okay, so I hope I'm clear to all. And I just see few people here. Just share this link. I mean, come on, we are just 150 of us. Share this link in all the WhatsApp groups for the students who are preparing for SBR or FR. We need more attendance. Come on, we need to be energetic and we need to make sure that we pass this paper. And I need everyone high on energy. This is going to be a long session. So have a cup of coffee with you, glass of water, whatever it takes, just have it. And just start with our session. I'll just begin now and I will share my screen with you. And of course, if there would be any doubts, I will give you a time to ask those doubts. If you randomly put questions in the chat box, it's not possible for me to clarify on those. Okay. So this is a free session. There are a lot of attendees. So I can't take up all the doubts here. So I request you when I say ask your doubts, then only you put up that in the chat box. So is this session recorded? Yes, whatever comes on YouTube, it stays on YouTube. So if you are watching this session, this is recorded and this will be shared. This will be there in the live tab of my YouTube channel. Okay, so no need to worry on that. Will we have breaks in between? Yes, a little ones, like 5 to 10 minutes break, not much. So let's begin with our session with all good vibes and let's start with SBR Grand Revision. Okay, so to begin with, guys, I will just tell you few things first. Okay, let me just open my Word file first of all. You're not supposed to write along with me. I hope that's clear to all of you. You're just supposed to see the screen and not do any typing, writing, whatsoever it is. You have to just see the screen in front of you. Okay, so here we are. This is our SBR Grand Revision, and I will just give you a title here. This is SBR Grand Revision of December 2024. Now to start with, I will start with FR concepts, okay? So the first concept which is important from FR and SBR perspective is the concept of non-current assets. Now, what in the world are these non-current assets? So any asset which is held for, any asset which is more than held for more than 1 year is a non-current asset, correct? Now, when I say asset, what is an asset? Come on, nobody taught us this. How do you find the definition of an asset? Now, that comes from conceptual framework. This conceptual framework was revised in 2018 and it gave us new definitions of asset, liability, income, expense, and this is very important from both FR and SBR perspective. Especially from SBR perspective, whenever you're stuck in a situation when you don't know which standard is applicable, what you apply is you apply conceptual framework. So what is a conceptual framework? It is the binding principles behind IFRS. That's what a conceptual framework is about. That's what conceptual framework actually is. So conceptual framework gives us the definition of an asset. So what is an asset? An asset is something which is a positive thing. That means asset is something which leads to inflow of economic resources, right? So there will be inflow of economic resources. That's what an asset is. And prior to this, this is something that you control. Asset is something that you control. So the keyword is that I can't say that tomorrow I will make income, so that's my asset. No. Income is not that you can control. Income is not in your hands. What are the market factors? Economic downturn is going on, recession is going on, or there is a people are purchasing a lot, so you will make more profits, you will make more income. So that's not in your hands. So any asset that you can control, which will lead to inflow of economic resources, is an asset. Now, prior to 2018, we had the concept of probability in the conceptual framework. So probability concept was removed from the definition of asset. From the definition of asset, probability concept was removed in 2018. So in 2018, the probability concept was removed from conceptual framework. Same for asset, same for liability. So you will see, but the probability concept, but the same probability concept was not yet removed from other standards like IFRS 5, where we still talk about probability. We still talk about probability, right? So we still talk about probability in that concept that has not yet been, that has not yet been removed. So we will say, therefore, there is always a conflict between IFRS and conceptual framework, but conceptual framework is voluntary to apply. Therefore, in this conflict, standard always wins. IFRS always wins. So even if IFRS 5 talks about the probability concept, but the conceptual framework does not talk about the probability concept, we will still apply IFRS 5. We will still apply IS 37, which talks about probability. It's a bad thing that conceptual framework was revised, but there was not a simultaneous rectification in other standards. That's reality, but it should have been there, but it was not there. But in this situation, the standard will prevail. So whenever there's a conflict between CF and accounting standard, it's the accounting standard which prevails, right? Then what we have as a definition is liability. So what is a liability? It's a present obligation which exists due to past event, okay? And this is something which will lead to outflow of economic resources. Now, again, here also we have removed the concept of probability. Why did we remove the concept of probability? Does that not strike your mind that why do we remove this probability concept? Because probability is based upon judgment. How probable you are that you will pass? You pick up a rose, flower, and you just pick up the petals and say, I will pass, I'll not pass, I'll pass, I'll not pass. So there's no proper probability attached to it. So just like that, in world, the things that happens, the things those happens, there is no probability attached, which is a fact. So it's everything is based on judgment. It's based on estimate. And anything which is based upon estimate or judgment is based upon assumptions, is judgmental or is subject to management bias. So to remove that management bias, we have removed the concept of probability, right? Then similarly, we are given the definition of income. We are given the definition of income as anything which increases equity, decreases liability, or increases asset is what I mean by income. What do I mean by expense? Everything bad is an expense. So anything which decreases equity, decreases asset, or increases liability is an expense. So these are the definitions given to us by conceptual framework. Now, in the same conceptual framework, guys, we always also talk about that what is the qualities or what are the qualities of financial statements. So there are two types of qualities. One is primary quality. Primary qualities have a concept of faithful representation. Okay, so faithful representation is there, plus there is a concept of relevance. So what is faithful representation? So we have to present everything in a complete neutral, you know free from error. So complete neutral free from error is the faithful representation. Plus in faithful representation, we also talk about substance over form. What is substance over form? When we talk about the economic substance of the transaction over its legal form. So basically, just have a throwback on IFRS 16 sale and lease back. You've actually sold your asset, but still you refer to IFRS 15 to consider whether it is actually a sale or not. So what is that? You are looking at its economic substance and not the legal form. Legally, it's a sale, but still you are like, okay, it might not be a sale, so let us refer to IFRS 15, right? So that is what quality of financial statement is. Faithful representation, which means our financial statement should be complete, neutral, free from error, plus they should have substance over form. What is relevant information given in the financial statements? Relevant information is nothing but something which is material. So that we include everything in our financial statements, which is material. What is material? Whose obscurement? What is obscurement? Hiding. So anything that I obscure from financial statements, misstate in my financial statements, or omit in my financial statement, if that is going to affect the decision of the user, then yes, it is a material item. So everything which is material should be reported. That is what I mean by relevance of quality. So quality of financial statement is that all the things that are reported in financial statements must be relevant. So one is faithful representation, second is relevant. Okay, great. What are the secondary qualities of financial statements? Come on, everyone, in the chat box. What are the secondary qualities? What are the secondary qualities of financial statements? Secondary qualities. So it should be comparable. It should be understandable. It should be timely. And verifiable. Very good. So this is what we have. So this is comparable, understandable, timely, and verifiable. And yes, this is FR and SBR combined revision, please. And first few hours are for FR and SBR both. Last few hours will be just for SPR. Okay, so this is what secondary qualities of financial statements mean. Now comes the fact that, okay, these are my conceptual framework rules. So in SPR, just for SPR students, some important aspects from conceptual framework you should understand that, there are certain conflicts. For example, let me give you the example of conflicts. First conflict is probability conflict. Second conflict is, for example, if I talk about a situation where, in IFRS 2 share-based payment, an expense is recorded and equity is recorded. In equity settled, I'm talking about SBR students only, in equity settled share-based payment. But as per conceptual framework, expense is when equity reduces. So what is the journal entry of equity settled share-based payment in IFRS 2? Expense debit, equity credit. So you are recording an expense and your equity is increasing. So this is against conceptual framework, because conceptual framework says expenses, anything that reduces equity. So share-based payment is an expense recorded and equity is recorded in equity settled share-based payment. But as per conceptual framework, expense is when equity reduces. Therefore, this is a clear conflict between, this is a clear conflict between the, conceptual framework and IFRS. So what you have to do is IFRS will prevail here. So this is an example of conflict, which was also, tested in Marquee Company question in your SBR, if you remember it. So we are supposed to give a logic here that maybe we are recording an expense because we are utilizing a human resource, and human resource is an asset. So by using the services of our human resources, we are in a way, utilizing our asset, we are decreasing our asset. That is why we have recorded an expense. So this is something that you need to memorize from conceptual frame. Okay, let's move on to the next standard when I talked about non-current assets. Now, in non-current assets, I will draw a table in front of you where I will compare the IS 16 with IS 38 and IS 40, that is investment property. So let us compare these few, standards. So first is IS 16, property, plant and equipment. Then we have IS 38, intangible assets. Okay. You have to just see me writing it, not write along with me, because I'll share this file with you. Then we have IS 40 on investment property. Now IS 16, what is the definition of PPE? PPE is anything that I use in my manufacturing process, for manufacturing, for office purposes, for admin purposes, or to give on rent to others. Own use, self-use. This is what PPE is. What is an intangible asset? So intangible asset is anything which is, non-monetary asset, which has no physical substance. That means you can't touch it, see it, transfer it, which has no physical substance. What else is there in an intangible asset? Come on quickly in the chat box. What is there in intangible asset? Non-monetary item, no physical substance is there. It is identifiable. What do I mean by identifiable? Identifiable means that either it can be sold separately, that means that asset can be sold separately, or it arises out of legal or contractual agreements, right? So this is what identifiable is. And then we have a reliable measure of it. That is when we record an intangible asset. What about investment property? Investment property is any property which is like idle property, which is held for capital appreciation, or something which is given on rent to others. Rent to others. Now, what is the difference between these two? What two? Just have a look on the board. What is the difference between this rent, which is here, and this rent? The difference is that in IS 16, we talk about, for example, there's a building. Okay. Zippy company, SBR students, refer Zippy company. If you remember that question where they asked you about the apartment blocks. So here, if there is a building which has 3 floors, one, two, three, four, okay? And on the first floor, the owner is living, fine. And the second and the third floor and the fourth floor are given on rent. But you cannot practically separate the first floor from these 3 floors. That means, let's suppose this is a city where people are not allowed to live like, they're not allowed to sold floor-wise property. So if they want to sell, they will have to sell the whole building. Maybe that's the way they follow in this particular, you can say, jurisdiction. That's what the rule they follow. So to give on rent, in that case, if I cannot separate the first floor from the second and the third and the fourth floor, then I will say this whole building is IS 16. Okay. Otherwise, if I can separate it, the first floor will be IS 16 and the second and the third and the fourth floor, which are given on rent to others, will be investment property. So this is how you bifurcate between IS 16 and investment property of IS 40. Now comes the accounting treatment, guys. Let us look at the accounting treatment of both of them. First, we will talk about initial accounting treatment. So initial accounting treatment is that I need to record my property, plant and equipment at cost. What is the cost? Cost is purchase price. Okay. I need to have my purchase price. In that, I need to add my directly attributable cost. So directly attributable costs are which are helping you to bring the asset to its present condition. Okay. So in that, make sure that you remember borrowing cost is also added, and make sure you remember training cost. Training cost is never capitalized. Why is it not capitalized? Because you can never control the training cost. Okay, you can never control. Today 206 people are here, and can I control out of 206? Are everyone, is everyone learning the same way? Is everyone, understanding the same way? I can't control that. Yes. So I can't control these things, which is why I cannot control the training cost. It is not in my control. So that's why it is never capitalized. And in that you add any, irrecoverable taxes, you add those as well. If there is any import duty that you have paid, you add that as well. So these are the things you add into your initial cost. Okay. And then if there is any present value of dismantling cost. So if you know that this asset will be dismantled in future, what is its present value? You add it into the initial cost. Same you do for intangible asset. Okay. Copy paste. Same is the initial accounting treatment for intangible asset, and same is for investment. Next comes our subsequent accounting treatment. What is the subsequent accounting treatment? So in subsequent accounting treatment, what happens in IS 16 is either you follow cost model or revaluation model. So what is the rule of cost model? In cost model, you keep your asset at cost minus accumulated depreciation minus any impairment that is charged on that asset. So this is the carrying amount. This is known as carrying amount. So we keep our asset at carrying amount. And what are the rules of revaluation model, guys? Very important to understand. See, revaluation model is applied, and in there, you can't do cherry picking. That means no cherry picking means you cannot say, I will just revalue one asset. If I am revaluing one asset, I need to revalue the whole class of assets. So no cherry picking is allowed in revaluation model. Okay, so that's one thing. Second thing is that in revaluation, if we are doing revaluation upwards, the gain goes via other comprehensive income. If I'm doing revaluation downwards, Then the loss goes via statement of profit and loss, right? So first, if you're doing revaluation downwards, you first take the gain, sorry, the loss via previous surplus. If that does not exist or that does not suffice, then you take it via P&L. That's how you treat your revaluation gain or loss. Right? So revaluation upward goes via OCI, revaluation downward first goes via previous surplus and the remaining via P&L. Right? Then what we have is in revaluation model that revaluation model says that we create a surplus. So that surplus is created via OCI and that is stored in other components of equity. And a revalued asset is always depreciated on the basis of remaining life of the asset. So you depreciate the revalued asset on the basis of remaining life of the asset, right? And that's what you do on revaluation. Same applies, exactly same treatment applies onto IS 38. The only difference is that in IS 38, we follow amortization. So for depreciation, instead of depreciation, we follow amortization, which happens for definite life assets. If your asset, intangible asset is indefinite life, then you are supposed to conduct annual impairment review. Okay, you're supposed to conduct annual impairment review. Okay. Next, what else do I have in investment property? That is IS 40. What is the subsequent accounting treatment? The subsequent accounting treatment is basically either cost model or fair value model. So what happens in fair value model? What are the rules of fair value model? So in fair value model, you are, you know, uh, you do not depreciate. Do not depreciate your asset. So if you have an investment property under fair value model, you're not supposed to depreciate that property because it is held for capital appreciation. And then you're supposed to take the asset to fair value at each reporting date. Unlike revaluation, when do you conduct revaluation? Revaluation doesn't happen at each reporting date. Revaluation only happens when there is a need for revaluation, right? So in fair value model, we take it to fair value at each reporting date. And if it is a fair value gain or loss, it goes via P&L. So everything goes via P&L in fair value model. So this is what happens in fair value model. I do not depreciate. I do it at each reporting date. And the gain or loss always goes via statement of profit and loss, right? So these are the rules that you're supposed to remember from these standards. IS 16, IS 38 and investment property, which is IS 40. Right? So this is very important from FR and SBR perspective, both. Are we all clear? Are we all clear on this? Quick confirmation. Are we all clear on this? Yes or no? Yes. Are we all clear on this? Okay, fine. Let us move on. Okay. Next standard in our understanding, let us complete first of all more parts of IS 38. Okay. So most other parts of, yes, I will share the slides with you after this, IS 38. In IS 38, you should also know about a very important concept that I'm going to teach you now is difference between research and development. So you should know that research is expensed and development is capitalized. How to differentiate between these two? What is research and what is development? For that, you need to know the pirate condition. If the pirate is met, then it is development. Otherwise, it is research. So, what is pirate? Let's understand the pirate condition. P stands for that, in this research we have done. What is pirate condition? P stands for that there is a to probability that, or there's a probable inflow of economic resources due to this development, due to the development. So if you think that there will be an inflow of economic resources due to development, then yes, it is a development. Then you have an intention to complete the development. That means you have not started this development just like that. You have an intention to complete it. You will not leave it midway. Then you have the resources to complete the development. Then you have the ability to use or sell the developed product or service. Use or sell the developed product or service, right? And then you have the technical feasibility, okay? That must be there to complete the development and use the developed thing. Then E stands for that you have a proper estimate of it available. Estimate of development cost is also available, right? So these are the things that you include in your pirate. If pirate is met, then it is development, which is capitalized. Otherwise, even if one of it is not met, then it is research, which is expensed. Okay. Then comes the other part of IS 38, where we talk about internally generated goodwill and brand. So now what happens here? See, internally generated goodwill is never recorded, irrespective of single entity accounts or consolidated accounts. We never record internally generated goodwill, even if upon consolidation, if we see that someone has consolidated internally generated goodwill, we actually criticize it and we say, no, you're not supposed to record internally generated goodwill. So internally generated goodwill is never recorded, irrespective of single entity accounts or consolidated. Then what about the other things? Internally generated goodwill, then internally generated brand. See, internally generated brand is not recorded in single entity accounts, but is recorded in consolidated accounts at fair value. So this is one of the danger items upon consolidation. So we record it at fair value, the internally generated brand. That's it. So these are the things that you know from IS 38, extra rules. Then comes our next standard, which is IS 36, which is impairment of assets. So what is the impairment of asset? We should first know the definition. It's a reduction in value of the asset. Reduction in value of asset is what I call as impairment. So what happens in reduction in value of asset is we keep the asset or we record the asset at lower of carrying amount and recoverable amount. And how do you calculate the carrying amount? You all know it is cost minus depreciation minus impairment. And when I talk about recoverable amount, what is recoverable amount? It is higher of value in use and fair value less cost to sell. How do you calculate the value in use? Value in use is present value of future cash flows from that asset. And in that, how do you value your growth rate? So the growth rate of cash flows is either zero, reducing, or stagnant, right? Constant. So this is how you keep your growth rate while calculating your value in use. And value in use is something which is subject to management bias because there is a risk that people might have made incorrect judgments, right? And then what you have is fair value less cost to sell. You all know how to value that. And then how do you report your loss on impairment? So the loss on impairment is treatment is same as revaluation down, right? That's what you do for loss on impairment. Now, if you are impairing a CGU, what is a CGU? Let's understand what is a CGU. Cash generating unit. So cash generating unit is a smallest group of identifiable assets which can generate independent cash flows. So that means one CGU, for example, in a restaurant, there is a bar area. So there are just customers who just use the bar area. So that is a CGU in itself. So it's the smallest group of identifiable asset which can generate independent cash flow. So again, here in a CGU, we always allocate corporate assets to each CGU. What are corporate assets? Assets like brand and goodwill, which are omnipresent in the whole company. So if I talk about JW Marriott, which is a chain of hotels, so it has various CGUs. It has a CGU where functions are conducted, banquet halls are there. It is a CGU where rooms are there, which people use. They book when they travel, and then we have a proper CGU of office areas or the meeting areas. So all these things or bar area, eating places, that is a separate CGU, but they all have one thing in common, and that one thing in common is the goodwill of JW Marriott. So every CGU has a corporate asset which is allocated to it, right? So how do you actually calculate your or how do you allocate the impairment to CGU? You first allocate it to the damaged asset, then you allocate it to the goodwill completely, and then the remaining is allocated to other assets on pro rata basis, right? This is what we do in IS 36 impairment, right? Then there's a concept of impairment cap, or you are always whenever impairment, I'm just writing for your revision purposes, whenever impairment happens, then each year the entity must review if there was a reversal of impairment. Reversal of impairment can only happen up to the extent of what would have been the carrying amount of the asset if there was no impairment at all. The extra reversal or reversed impairment other than the cap amount is treated as revaluation surplus. Now, this is something that I've explained in my lectures with examples, numerical examples that I cannot take right now. But I hope everyone knows the concept of reversal of impairment. You are supposed to, whenever you charge impairment, you're supposed to check whether there was a reversal in impairment, whether there was any improvement in the conditions. And if there were improvements, then you're supposed to reverse it. So let's suppose you charged an impairment of 1,000 5 years ago. That does not mean today you can reverse 1,000. No, it will be a reduced amount. using the methodology to calculate, maybe that amount comes out to be 800. So out of 1000, you can only reverse up to the extent of 800, and the extra 200 will be treated as your gain. So that will be treated as your revaluation surplus. And then you all must know that impairment, once charged to goodwill, is never reversed. And of course, when you are supposed to check for impairment, there are always something which is known as indicators of impairment. That is when you conduct impairment review. So first indicator is internal indicator. Then we also have external indicators. That's it. So this is what we have from IS 36 that you all need to remember, right? So this is very important standard in itself from FR and SBR perspective both. Now let's come on to the next standard from NCA. I will share this file with you, so there's no point of typing it along with me or being worried about whatever I'm saying or typing. Just listen to me, that's enough. Okay, next standard that comes into my mind from non-current asset is IFRS 5, which is very important, which is NCA held for sale and discontinued operation. So now guys, you must all know that what is a discontinued operation. So let us first understand that when are non-current assets held for sale. So held for sale or discontinued operation, this will only occur if caption is met. What is caption? If caption is met, what is caption? See, it's again an acronym where C stands for commitment to sell the asset or discontinue an operation, where A stands for active plan to sell the asset. That means you've started negotiations. P stands for that the sale will happen in present condition. That means there will be no repair, maintenance, or any extra improvements on that asset. Where S stands for that their sale is probable. That you're very probable that the sale is going to happen. So sale is probable. And O stands for that the sale will happen within 1 year, and N stands for there will be no change to the plan. So if this caption is met, that is when we say that either the asset is held for sale or it is a discontinued operation. Now, what is a discontinued operation? Let's understand what is a discontinued operation. See, any operation which is a very different thing, which is like, it is a separate operation in itself, either due to its nature or its, size. So discontinued operation is when you discontinue, your, okay. So discontinued operation is when you discontinue an operation, which is, okay. So any operation which is about to cease, and is a significant separate operation due to its nature, geography, or size. Okay, it's a separate operation. And then what we have is that either or it's a subsidiary which was purchased just with a view to resell. That means you purchased the subsidiary just you wanted to resell it. So the initial date you purchased this subsidiary, your intention was to resell it. If that is the situation, then yes, even that subsidiary is classified as discontinued operation. So it's a discontinued operation plus the caption is met, then IFRS 5 is applicable. What are the accounting rules or accounting treatment? What is the accounting treatment of discontinued operation. So here we record the asset at lower of cost and NRV, classify the asset as current asset, stop depreciating the asset, and include stop depreciating the asset, and if it is a discontinued operation, give a separate disclosure in statement of profit and loss, as this is like profit from discontinued operation. See, if it is not a discontinued operation, but you are selling, if not discontinued operation, but many assets and liabilities are being sold in a single transaction, then I would say this will amount to be known as a disposal group. So if it is a disposal group, then also the accounting treatment remains the same. Record the asset at lower of cost and NRV, classify the asset as current asset, and stop depreciating the asset. These are the three most important rules under the accounting treatment of IFRS 5. That's it. This is what you should know from IFRS 5, which is just an overview of the standard. Okay. Next standard is IS 23. So next standard is IS 23, which all FR and SBR students have done. So this is based upon borrowing cost. Yes. So in borrowing cost, we talk first about qualifying asset. So what is qualifying asset? Any asset which takes substantial time for construction. Okay, or substantial time to bring it into use. That is a qualifying asset. So if there is a qualifying asset which you have financed, the finance cost on qualifying asset is capitalized into the cost of asset during the time of construction. Okay, and until the time it is ready to use. So once the construction is completed, once construction is completed or loan is repaid, whichever happens earlier, the capitalization stops. And the capitalization starts whenever the construction starts. So it's like whenever the construction is going to cease, the capitalization is also supposed to cease. Whenever the construction resumes, the capitalization will also resume. So that's what you do in IS 23. If you have taken general borrowings, you capitalize your borrowing cost based upon capitalization rate. And if you have used your general borrowings, what are general borrowings? Yes, this standard is part of SBR. General borrowings are, for example, I've taken a loan of 6 million at the rate of 6%, and I've taken a loan of 4 million at the rate of 4%. So let us suppose that I need to calculate the general borrowing capitalization rate. I will calculate the weighted average cost of capital, which will be 6 million into 6% plus 4 million into 4% divided by the total loan amount, which is 10 million. So this is how you will calculate your weighted average cost of capital, which will be used for your borrowing cost capitalization. That's what is given to us in IS 23 borrowing cost, which all must be knowing. Okay. Fine. So are we all clear till here? Just give me a quick confirmation. Are we all clear till here? Okay, great. Fine. Let us move on. This is IS 23. So basically, we've done the most important standards from non-current assets, IS 16, IS 38, IS 40, then IS 36, IFRS 5, and then IS 23. Okay. Next comes the standard as per FR and SBR syllabus both, which is an important standard from everyone's point of view. That is IFRS 15. IFRS 15 revenue from contracts with customer. So revenue from contract with customer. So what is this standard? First of all, you should know what is revenue. Revenue is proceeds received from the sale of goods and services in normal course of business. In normal course of business. So whatever you do in your normal course of business, something that is like in general. So if I'm teaching, that's my normal course of business. If you are into like grocery shop, you have a grocery shop. So your normal course of business is that. So revenue is the proceeds that you receive from sale of goods and services in normal course of business. Now to record this revenue, there were complex contracts, which is why IFRS 15 was introduced, which gave us a five-step approach. What is this five-step approach? First step is identification of contract. So what is a contract? First of all, we all should understand that a contract is a dual party contract where two or more parties, they are getting into an agreement where they identify their rights and obligations. Okay. So where they identify their rights and obligation, that's what a contract is, where two or more parties get into this and they, identify their rights and obligations. And this is a contract which is signed, between these parties, and it gives rise to, like, there are some payment terms, and these payment terms are identified. And this contract must have an economic substance. Contract must have economic substance, because if you don't have that, then there's no point. Because what is economic substance? That's more like when you're talking about that you're doing it for money, right? It should not be a charity contract. And then it should not be one-sided. It should be both the ways, right? So this is what I mean by a contract. Then second step is after identification of contract, I'm supposed to tell that, okay, what is the transaction price? Okay. So rather than transaction price, it is what are identify the separate performance obligations within the contract. So in here, you all should know that what is the difference between distinct. Okay, what is distinct performance obligation? What is a distinct performance obligation? From the perspective of buyer and seller both, these performance obligations are independent from each other. So delivery of one is not dependent on the delivery of other. That is what I mean by distinct performance obligation. Buyer also wants to buy these performance obligations separately, and even the seller is giving these performance obligations separately. So they're independent from each other. That's what I mean by distinct performance obligation. So within one contract, there can be various distinct performance obligations, correct? So within one contract, there will be separate performance obligations that I need to identify. Then third is the step of determination of transaction price. Okay, so third step is determination of transaction price. This is a very important step. Determination of transaction price. So what is there in transaction price? It is basically where we talk about the transaction price is when we talk about various elements of the transaction price. There can be fixed element, variable element. So for example, we talk about variable consideration. So, because you're providing certain services or goods to a customer, you have agreed upon a price. Now, there can be a variable aspect to it. There can be a variable consideration. So, we record the variable part of it based upon probability. That means we calculate the expected value, and based on that, we actually, record the transaction price. So there's a very silly line which the standard has used that you record the transaction price up to the extent it is probable that there will be no reversal. So basically you're saying it is probable that this transaction price will be received. I need to record that transaction price on the basis of probability. So it's basically expected value. Then the second is when I talk about financing component. Now, sometimes, you have a financing component that means the revenue was or the service was provided on 1st January 2020, but you are going to receive the money, let's suppose, after 2 years. So there is a financing component, right? So you are supposed to take it to the present value, and whenever you take anything to the present value, you always must take into account unwinding of interest. Then after financing component, what else is there? What else is there apart from financing component? We also have the other aspects, which includes like cash consideration paid to customer. So what about you pay something to your customer? For example, you know you wanted to call someone for the classes on the outskirts of the city. So let's suppose you're conducting your classes, your sessions in the outskirts of the city, and the customer, or that means, the person who's getting trained, that person is saying that I can't travel, so I need a travel allowance. So I charge some money for the training sessions, but I'm also giving travel allowance to the students. So in that way, I'm giving money to the customer itself. So that means it's a consideration that you pay to the customer. So if you pay such a consideration, it is recorded as a reduction in transaction price. So if you give, let's suppose I was teaching SBR crash course for around $100, and I gave a travel allowance of $40. So I will say the transaction price of the crash course was 100 minus 40, that is $60, right? So this is how you determine the transaction price. Then we also have non-cash consideration. Sometimes what happens is we enter into a barter system. We are like, okay, you give me this service, I'll give you this service. So in that case, what is your transaction price? Transaction price is the fair value of goods or services received. So what is the fair value of goods and services received? If that is not available, if that's not available, then transaction price is equivalent to fair value of goods and services given. So what is the fair value of goods and services that you have given? That's how you determine the transaction price, right? Then what we have as our fourth point is allocation of transaction price to separate performance obligations. So how do you allocate? You allocate it on the basis of stand-alone selling prices, right? You allocate it on the basis of standalone selling prices. And if that standalone selling price, you have to use that. So basically, for example, I'll just give you a small example. In a particular contract, we are providing computer plus we are providing after service of the computer. So if I talk about its transaction price, let's suppose the transaction price is equivalent to dollar. Let's suppose it is equal to dollar 200. And if I talk about individual selling price, the computer is sold individually for $180, and the after service or after service cost is for usually individually it is, let's suppose, $50. So I am giving something worth of 180 plus 50, which is actually 230 for a cost of 200. So how will I allocate the transaction price? I will say for computer on the basis of tangible selling price. So it is 180 out of the 30 fair value. I need to allocate 200. So this is how I will allocate the transaction price to separate performance of, right? Okay. Then what do I have is fifth point, which is the most important one, which is record the revenue. Now, when revenue is recorded when the control passes or when the performance obligation is satisfied. Now, how do you determine when the performance obligation is getting satisfied? You determine this by simply looking at when the control has passed on. What are the indicators of control being passed? The title has passed, you've received the money, you've recorded a receivable, physical possession has been transferred. So how do you record the revenue? You record the revenue either at a point in time or you record the revenue over the period of time. So we record at a point in time revenue whenever, we record it whenever it is not over the period of time, then it is at a point in time. And when is revenue recorded over the period of time? Revenue is recorded over the period of time when either of these three conditions are met. What are these three conditions? One is customer simultaneously receives and consumes the benefit. So customer simultaneously receives and consumes the benefit. That is when you record the revenue OT. For example, this training session. So as in when I teach you, you are consuming this benefit. I can't ask for the training back. Then when you enhance or create an asset controlled by the customer, where you have an enforceable right to payment. So basically, for example, there is a property which you are constructing, the land belongs to the customer, but you are doing the construction part. So you can't just run away with the land, right? So you can't run away with the property that you've constructed because legally that land belongs to the customer only. So whatever you're creating or enhancing on that piece of land, that is basically something that you've transferred. You can't take it back now. That is why the revenue is recorded over the period of time. Then if you are doing customization, if you're preparing some customized asset, for example, you're enhancing or creating an asset which is controlled by you, but there is no alternative use for you. So you're customizing this asset for that counterparty. In that case also, this is something which is a revenue is recorded over the period of time because this also automatically gives you the right to pay. So if you're customizing something for someone, you can't say that, okay, you have a right to payment in that situation because you've done it in a custom. So this is what we do in our 5-step approach to revenue. Okay. So this is very important for FR students as well as SBR students. Now we have another concept in this revenue where we talk about how to actually record. There is a 4-step approach, especially in FR, it's very much relevant. Whether there is a 4-step approach to record revenue. Step number 1 is that you see whether the contract is overall loss making or profiting. See, if it is loss making, you record the full loss immediately, right? Then if it is profitable, then you record the revenue and cost on the basis of the progress in work. Because you're saying now that the revenue is recorded over the period of time. So when the revenue is recorded over the period of time, then yes, you need to see whether it is profitable. So you need to base your decision basis of the progress. Then the step number two is where we see that what is the progress. So progress is calculated either by using input method. That means how many costs have been incurred, basis of cost incurred. And what is output method? Output method is on the basis of how much revenue have you made. So let's suppose you said that I estimate that I will make this much revenue out of this, or let's suppose I was building, or what is the result? I was building a property and I said I will build a fourth floor property. So by now it has resulted in two floors. So I will say it's a 50% progress. Input method is I estimated there will be a total cost incurred of 10 million, right? So 10 million means I have by far, estimated out of 10 million, I've already incurred 5 million. So that 5 million cost that I've incurred, that means 50% profit. So you calculate the progress on the basis of input or output method. Then you finally, step number 3 is you calculate how much revenue is to be reported. So step number 3 is you record the revenue. So revenue is reported as revenue into percentage of progress. That's how much revenue is recorded, and costs are also recorded. Costs till date are recorded. And then finally, what we have is step number 4, where we calculate the contract asset or contract liability. So how do you get to know about contract asset and contract liability? If the revenue that you have recorded is greater than the money received by far from the customer. So the work that you've done has been worth of 1 million, but the money that you've received is, the money that you've received is 5 million. So that means there's a contract asset. So if revenue is greater than the money received, you have a receivable, which is a contract asset. And if the revenue is lesser than the money received, then that is contract liability. That means that's a deferred income. You've received more money from the customer as compared to the work that you've done. So that's a deferred income or contract liability. So these are the 4 steps that we follow for recording the revenue. Then in the same standard, we also have a concept of, when you sell something, but then you also have some options. Okay. So for example, it is basically sale and repurchase. This concept is there in FR and SBR, sale and repurchase. So if I sell something, but I have an option to repurchase. So how to record that? So there is a forward option, there is a call option, and there is a put option. What is forward? Forward is that entity has sold the asset once. Okay. Entity has sold the asset once, but has to buy back the asset in future. It's obligatory on you. There's an obligation on you that you have to buy it back in future. Now that is not revenue. This is not revenue. That means you have not transferred the control. So you have sold something, but you have to buy it back in future. So you have not transferred the control. So this is not a revenue under the IFRS 16 sale and repurchase. Right? So this is not revenue. If this is not revenue, then what it is? This is more like you received money by selling something. It is rather treated as a loan. Loan on collateral. You all know collateral. Collateral is like in Hindi we call it as give me. So you've kept something as a collateral and you received the loan. So loan on collateral. Then call option. What is call option? This is an option which lies with the once you've sold something, now you have an option to call it back. So call option is again, this is not revenue. Put option. What is put option? This is an option with the buyer. The buyer has an option to give it back to you. Now put option is of tax. Put option with obligation. That means if buyer gives that item back to you, do you have an obligation to take it back? And second is without obligation. With obligation and without obligation. Now, if it is with obligation, it is not revenue. If it is without obligation, then yes, it is revenue. And whenever it is not revenue, what it is? See, if not revenue, in case of forward call and put with obligation, then what? See, if the repurchase price under that agreement is greater than the original selling price, that means once you have sold it and the moment you will buy it back, you have to buy it back at a higher amount. If that's the situation, then it is a loan with collateral. And if the repurchase price is lower than the original selling price, then it's like you've given it on rent. So it is a lease. So this is what the concept of sale and repurchase is. We've done a lot of questions in SBR on this. I remember there was a question, I think Jacinta company question in SBR, which was very important for this particular concept. Are we all clear on this IFRS 15? I've completely revised IFRS 15 with you. And there are a few other parts or aspects to it like contract modification, but I don't want to touch on that. Let's keep it simple and just do the important bits. Are we all clear till here? Any doubts? Okay. So guys, let us take a small break of 5 to 7 minutes and then we will resume with IFRS 16, then IFRS 9, and after that we'll do group accounts. Okay. So let's take a break of, then after that SBR, IFRS 2 and IFRS. Let's take a small break of 5 to 7 minutes and get back with the grand. I hope I'm audible to all of you and we are all back from the break. Please confirm to me over the chat box. Okay, good to go. Yes. So this is basically IFRS 15, and now we would begin with our next standard, which is IFRS 16. Let us see what's happening in IFRS 16, which is basically all leases. So IFRS 16. Okay. So IFRS 16 leases. See, first of all, you all must know what is a lease. So when you rent out something, that is what lease is. And the person who rents out the thing is known as, who stays on rent is basically the lessee. The person who takes the exit on rent is the lessee. And the person who gives the exit on rent is the lessor. The person who gives the exit on rent is lessor. Now you all must know what goes into the lessee accounting. So in lessee accounting, guys, we must know that it is that we initially record an ROU and a lease liability. What is a lease liability? Present value of future lease payments is what I mean by lease liability. And what is a lease payment? Lease payment includes the fixed lease payments that you do, any variable lease payments which are probable that you have to do. Then if you are, hoping to extend the lease and it is probable. So what is the extension cost? See, if it is probable that you're going to extend the lease, then what is the extension cost? Present value of that is taken into account, right? So what is lease liability? Present value of future lease payment is the lease liability. Then what is ROU? ROU is lease liability plus any payment made before, before or on the date of commencement of lease. So any payment that you make on or before the date of commencement of lease is also capitalized into ROU. So if you have paid any security deposit, that also becomes part of your ROU. Then what is the subsequent accounting treatment? What is the subsequent accounting treatment? For lease liability, you are supposed to unwind the interest, and for your ROU, you are supposed to depreciate it. You depreciate it like you have to see that this depreciation is going to happen at lower of the life of the asset or the lease term. Okay, so you have to do the depreciation. That's what the subsequent accounting treatment is all about. And then if I talk about the lesser accounting, what happens in the lesser accounting? Then you have to simply, in lesser accounting, you have to simply say that whether it's a finance lease or operating lease. If it is finance lease, what is finance lease? Finance lease is basically, when you have your asset at the end of the, lease will get transferred to the person. So that means I've given my apartment on rent to someone, and at the end of the lease agreement, that apartment will become lessee's apartment. That's a finance. So if it is a finance lease, your accounting treatment is as a lessor, you recognize your asset, recognize the asset, and you create a corresponding receivable, right? That's what you do. And whatever the rent that you're receiving is treated as your interest that you are getting. And if I talk about operating lease, in the operating lease, you record your rental income as and when accrued. So you record your rental income as and when. That's what you do for your lesser account. Now comes the next concept, and that concept is very important, which I wanted to do from IFRS 16. The rest of it is very easy. Sale and lease back. So when you sell something and then you take the same asset back on rent is what is known as sale and lease back. So what is the accounting treatment? You have to first, first refer to IFRS 15 to see whether this transaction meets the definition of a sale as per IFRS 15. So that's what you have to do. First, you have to refer to IFRS 15 and see whether it meets the definition of a sale. Now, if it is a sale, now there will be two outcomes. Let's insert the table from the perspective of lessee and lessor, if transfer is a sale and if transfer is not a sale. So if transfer is sale, as per IFRS 15, if transfer is sale, what will happen? And what will happen if transfer is not a sale? Now see, if transfer is a sale from the perspective of a lessee, what's going to happen? If it is a sale, then of course you will, be recognized. It's like you are selling off something, so you sold something and then you take it back. So if I talk from the perspective of lessee, this lessee is also someone who is the seller. So once you sell something, you are supposed to de-recognize it. So you will de-recognize the asset, record a receivable. Okay. Then after selling it, you are also supposed to take it back on lease. So you will also have to record your ROU. You will record your lease liability, and you will also calculate your profit or loss on disposal. How will you calculate your ROU? ROU will be calculated as present value of lease payment divided by fair value into the carrying amount of the asset. So ROU is calculated as PV over FV into CA. Now, if the transfer is above fair value, in this case, if transfer is above fair value, then the extra or the excess amount is treated as you've received more money than the fair value. So you treat that as your financial liability. And if the transfer is below fair value, then you treat it as prepayment, as an asset, right? So this is what you do. I hope everyone knows this concept. And profit or loss on disposal is calculated as a balancing figure. Okay, so this is a balancing figure. Then what else do I have? What happens in the books of the lessor slash the buyer? See, this person has actually bought the asset and is also given it back on rent. So he's going to recognize the asset, so he will record the asset. And after recording the asset, what else will he do? After recording the asset, he will simply also record a payable, correct? And then he would also, after recording the payable, he would simply also do his lesser accounting as per the IFRS. That means he will do either operational lease or finance lease. He will do his lesser accounting. And if the transfer is not a sale, then what happens is very important. If the transfer is not a sale, you will not be recognized your asset, that's for sure. And you will still receive some rents. So that, and you will, legally it is a sale, but economic substance says it is not a sale. So when you sell something, you receive money or you create a receivable. So that will be treated as your financial asset. It's like, it will be treated as a financial liability because you're receiving money, no? So when you receive money, that is kind of a money coming out of nowhere. So that will be treated as your financial liability. Okay. So that's what I do for the lessee or the seller if transfer is not a sale, right? Not de-recognize the asset, create a financial liability, and that's it. That's what I do. And whenever I pay rent, I treat that as interest on loan. Then what do I do from the perspective of the lessor? From the perspective of the lessor, if transfer is not a sale, he will still record the asset. Okay, so that means he is not the owner of the asset, so not on the asset, and he will then do his normal, like he's given loan to some. So for him, it's a financial asset that he has given loan to some. So that will be treated as a financial asset. When you take loan, it's a liability. When you give loan, it's an asset. So that's what you're going to do in sale and leaseback transaction under IFRS 16. Again, a very, very important concept of IFRS 16. I hope we all are clear on this. And if you ask me the question, I would say in SBR, there is a T value which is there on this concept by the name of Mobile Company. So make sure you check that out. I think I'm giving the right name. But there is a T value. I don't remember the number of T value, which is related to sale. So very important. That's so I hope we are all clear on these. Now let us do the IFRS 9. Okay. Before I start with IFRS 9, your all's favorite standard, let me just give you a small overview of IS 12, which is on deferred taxation. So what is there in deferred taxation? Just a small concept that I want to clarify. See, deferred taxation arises because there is a temporary difference. So temporary difference usually exists because of the difference between tax rules. Yeah, Mosaic company, not mobile company, it's Mosaic. So temporary difference usually exists because of the difference between tax rules and accounting rules, right? And what happens is tax base is decided by taxation standard or taxation rules, whereas the carrying amount is estimated on the basis of accounting standards. Whenever the tax base is greater than the carrying amount, this means that this year more tax is paid. This year more tax is paid, which means in future, this will create, if your tax base is greater than the carrying amount, that means you're paying more tax this year. So this will create future tax reduction. It's more like you all have a same syllabus to cover. So if you study more in advance, tomorrow you have to study less. So you're just bifurcating your pressure. So same way in taxation, we have to pay tax on our asset, and both taxation and accounting bodies, they're going to bring down the asset to its residual value, right? So all of them are going to bring it down to its scrap value. So this is a temporary difference which exists between tax base and carrying amount. So if I'm paying more tax today, I'll have to pay less tax tomorrow, which will give me a deferred tax asset being created. Similarly, what happens is if my tax base is lower than the carrying amount, that means my carrying amount is greater. So I paid less tax this time, which means more tax next time. So this gives rise to what? This gives rise to deferred tax liability. So this is how what you have in deferred taxation. Now in deferred taxation, we also learn about unused tax losses. So you can only carry forward the unused tax losses as per the jurisdiction or what is given in the case study. For how many years can you carry forward it? And you can only create a DTA out of unused tax losses. How do you calculate it? DTA is unused tax losses into tax rate. That's what a DTA is created. You can only do it if there is a solid evidence for the existence of future taxable profits. So it's like if you think that in future there will be taxable profits, then only you will create a DTA for unused tax losses, otherwise you will. So DTA is created for unused tax losses. If there is any DTL or DTA created due to revaluation, then since revaluation gain goes via OCI, then the related DTL expense or income will also go via, or basically expense, because on revaluation surplus you always have an expense, will always go via OCI. That's the right. So this is basically what we do in deferred taxation. There are more you can say elements to it. For example, IFRS 2 and deferred taxation, IFRS 16 and deferred taxation. But I don't want to confuse the FR students here. And they don't ask it generally in the exam. But you must have done the high company question, false company question for SPR. These are the questions which are very important from IS deferred taxation. And these unused tax losses is something which they just randomly ask for 4 to 5 marks. And in the case study, you're just supposed to tell whether the evidence of future taxable profits exist or not. So you will say that external evidence is more valued, and budgets and forecasts are not trusted upon as compared to any external strong evidence. Right? Okay. Next is your favorite standard, IFRS 9. Let us start with IFRS 9. Okay. Are we all ready for IFRS 9? Then after IFRS 9, we will take a short break and then start with account. But are you all ready set for IFRS 9? Ready for IFRS 9. Let's begin. Fine. IFRS 9. For FR and SPR students both, towards the end of IFRS 9, I will ask FR students to keep their hands on their ears so that they don't listen to the IFRS 9 difficult bits which are tested in SPR, unlike in FR. So IFRS 9, first thing is that you should know what a financial instrument is. So what is a financial instrument? It is a transaction or a contract which creates financial asset in books of one entity and a corresponding financial liability or equity in books of another entity. That's what a financial instrument is. Now, what do I mean by financial asset? Financial asset is again a contract which will actually lead to inflow of resources, like it is something which will lead to some cash incoming or some other financial asset income. That's what a financial asset is. So it's all things good. Then if I talk about financial liability, it's a contractual obligation. Financial liability is a contractual obligation which will contractual obligation to pay cash or another financial asset. That's what financial liability is. What is equity? Equity is residual interest in the net assets of an entity. In the net assets of an entity, the residual interest in the net assets of an entity is equity. Now guys, let's talk about financial assets. There are two types of financial asset. One is debt instrument, another is equity instrument. All the financial assets have one initial accounting treatment. What is the initial accounting treatment for all financial instruments? That you have to record them at fair value and capitalize the transaction cost unless the subsequent method followed is fair value through profit and loss. See, if you are using fair value through profit and loss, then you do not capitalize the transaction cost. Otherwise, yes, you do capitalize the transaction cost. If it is a liability, how will you capitalize the transaction cost? It will always be via deducting the amount from the fair value. If it is an asset, how will you capitalize the transaction cost? It will be by adding it to the fair value, right? So that's the initial accounting treatment for every financial instrument. Now, if I talk about debt instruments, which is a financial asset, what are the subsequent methods available? See, one method is A method is fair value, or you can say amortized cost. Second is fair value through OCI. Third is fair value through P&L. Okay, these are the three methods available for debt instruments. How do you check which method should I go for? There are two tests too. What are these two tests? First test is business model test. So there are two tests that you should see whether they are met or not. Based on that, you decide which method to choose. So first test is business model test. What happens in business model test? You basically check what is your intent behind keeping that asset. Like you want to keep that asset for long term, that debt instrument for long term. You want to keep it for short term, or you're not sure. So you check the intent. Then you also check the contractual cash flow test. What is contractual cash flow test? Basically, contractual cash flow test, you see whether all the payments or the payments are in terms of cash or not. That means you should solely receive the repayment in terms of cash for principal and interest. There should be no other benefit in kind. See, first of all, CCF test. First is CCF test. Once the CCF test is met, then you look for the business model test. See, first CCF test is met, then you look for the business model test. If CCF test is met and your intention is, please pay attention, if your intention is after CCF test being met, if your intention is to keep the asset for long term is your intention, plus CCF test is met. You want to keep it till maturity. Then you go for amortized cost, right? So when you go for amortized cost, what is your way of calculating? The model is like opening asset plus interest. So you take opening asset, add interest to it. So interest is effective rate of interest is what you use. And from that, deduct the cash that you have received, and that gives you closing asset. Right? This is how you calculate your amortized cost P. Then when do you use fair value through OCI? When this is I don't know situation. That means I might keep it, I might sell it. If there is a favorable situation, I might end up selling it also. So if it is I don't know situation and CCF test is met, then what I do is I keep it under fair value through OCI. Where basically I take my financial instrument to its fair value at each reporting day, and the gain or loss is reported via others comprehensive income. Right? That's what I do. Then what is fair value through profit and loss? Fair value through profit and loss is when you need to keep it for short term and CCM test is met, or irrespective of your intention, if CCM is not met, then also you keep it under fair value through profit. One example where CCF test is not met, example of CCF test not met is convertible debenture. Because when you buy convertible debenture, you just do not have an option to get a repayment in cash for principal and interest, but you also have an option to get the repayment in terms of your shares. You can convert your debt into shares. So that is an example where CCF test is not met, and we use fair value through profit and loss method. Okay. Now, equity instrument. What are equity instruments? When you buy shares of other companies. Now, you will keep them either under one, either this will be kept under fair value for profit and loss, this is by default method, or you will keep it under fair value for OCI. You keep it under fair value for OCI only if two conditions are. What are these two conditions? Must not be held for trading, and you must have made an irrevocable choice upon designation. Basically, upon choosing this, you must have made an irrevocable choice to keep it under fair value through OCI. So this is what we do in the equity instruments. These are the subsequent methods which are available. Okay. Next, let's see what's there next. Fine. After the debt instruments and equity instruments, what I have is my, the financial liabilities. Just give me a moment. Okay. Now comes the financial liability part. How do you record your financial liabilities? How do you record your financial liabilities? The financial liabilities are by default kept under amortized cost method. So you keep it under amortized cost method where your way of calculation is opening liability plus interest minus cash paid gives me my closing liability. Okay, you keep your interest using effective rate of interest. So this is by default method for financial liabilities, but we also have another method just for SBR students. For students, you don't know this and you need not know this. So we also have a method of fair value profit and loss for financial liabilities. So we opt for this method only when it is like you want to, the liabilities are held for trading. Okay, that's when you can opt for this. And second is when the liability is you want to use the fair value profit and loss to avoid an accounting mismatch, right? So this is what you do and when you opt for fair value through profit and loss. Now, fair value profit and loss of financial liability just for SBR students. This only happens when you want to avoid an accounting mismatch. Let's suppose you purchased an investment property which was kept under fair value through profit and loss. And to finance that investment property, you have also taken a loan. So it's like you're saying the finance, the finance that I've taken is because of the investment property. If that investment property is kept under fair value through P&L, then why not the loan that I've taken should also be kept under fair value through P&L? So then you might decide to opt for fair value through P&L. That means you want to avoid an accounting mismatch. That's a very big stake on judgment. It's all dependent upon the accountant's mindset, whether he wants to follow this or not. Now, the fair value can change because of entities or risk. Okay, fair value of a liability can change because of entities' own credit risk, and it can also change because of other factors. So if the change happens due to entities' own risk, then we take it via other comprehensive income in case of fair value P&L. If the change is happening due to other factors, we take it via the profit and. So this is what is there in our IFRS 9 basic. Now, all the FR students who are watching this, please close your ears because whatever I'm going to teach next is not relevant to you. You come back to this session once I begin with group accounts. Okay. So for IFRS 9, only the SBR students you guys are supposed to listen to. FR students, close your ears. Don't cry in the corner if you listen to what I'm going to say next because you are not being tested on that. Let us talk about impairment of financial assets. We'll have a quickly an overview over it. Impairment of financial assets. So what are the impairments or what's the impairment of financial asset? That is basically when we talk about loss allowances. So there are two kinds of loss allowances. What is the loss allowance? When you estimate that, I purchased some financial asset, a debt instrument, which was kept under fair value, OCI or amortized cost are the only two instruments which are being impaired. Okay. And once you see the loss allowance, what you see is has the credit risk of the financial asset increased since inception. That means the day you purchased it. See, if it has increased significantly, then you are going to keep the loss allowance as lifetime expected loss allowance. And this is basically for receivables, we always create a lifetime expected loss allowance. If it has not increased significantly, then I keep my, if it has not increased significantly, then I keep my loss allowance as 12-month expected loss allowance. Right? This is what I do. Now, once the loss allowance has been created, you must know that the loss allowances are probability weighted. Okay. They are at present value always. That's how you calculate your loss allowance. So what is loss allowance? Loss allowance is what do you estimate to receive, estimate versus contract. So, whenever you have, what is the debt instruments? When you give a loan to someone. So when you give a loan to someone, you always keep an eye on them, whether these people are going to repay to me or not, right? So when you keep an eye on them, there might be a change in your estimate. Maybe that person has lost his job. So maybe you will not receive an equal amount of money back. So that's why we say that our estimate versus contract. What is the estimate that you have now that this person is going to repay versus what he should have repaid as per the contract? That's what you check, right? This is how you create loss allowances. Okay. Then comes the concept of your, if you purchase a credit impaired. What is credit impairment? Credit impairment is when the debt instrument is fully, impaired. That means it's not a doubtful debt. It is not a doubtful debt. You're not saying that I have a doubt whether I receive money or not. It's sure that you're not going to receive the money. That is credit impaired. So when you purchase any credit impaired asset, so let's suppose the company has announced their bankruptcy and they're saying we will only repay 50%. So that is credit impairment, right? So if you purchase any credit impaired asset, you use credit impairment adjusted rate instead of effective rate of interest, right? That's what we do in case of purchase of any credit impaired asset. We've done questions on that as well in our SBR sessions, right? Okay, what else do we have? CIAR, we've read about this. Then what else do we have next is basically when we talk about derivatives. So what are derivatives? Anything which meets the definition of derivative would be who meets the three conditions. What are the three conditions? Derivative is something which has initial low or zero value. Then its value is dependent on underlying item. Then it is settled in future. So if these three conditions are met, then we say it is a derivative. And if it is a derivative, we follow fair value through profit and loss accounting treatment for all the derivatives. That's the rule of the thumb. So if there's a share option, there's a swap, there's a forward rate, there is any option which is available, then it is a derivative kept under fair value through profit. Now, under the same standard, we also have something by name of hedging, which is your favorite topic. I'm dead sure that you love hedging. So in hedging, you should know that what is hedging? It's like when you want to really, cut off your gains with your losses and come to a no gain, no loss situation. That's what hedging is. So what is hedging? Hedging is when an entity wants to hedge an item in the financial statements, which could be, it can be an asset or liability that you have recorded, or it can be unrecognized firm commitment, or it can be something like, future probable transaction. So to hedge against these, so when an entity wants to hedge an item, it buys an hedging instrument whose fair value changes in an inversible or in an inversely proportional way to the hedged item, so that if a loss is incurred on item, a gain will be incurred on instrument, thereby giving a no profit, no loss situation. That's what hedging actually means. And you do hedging only and only if the okay. We only do hedging and if the hedging criteria is met. So what is the hedging criteria? Hedging criteria is when there is an inverse economic relationship between the item and the instrument. Okay, that means if value of one increases due to the factors, the value of others should decrease. Second thing is that the credit risk of the item does not affect the fair value measured. So it's like if you have a receivable, so you don't want to see the fair value of that receivable based upon whether the person will repay or not. So you don't want the credit risk to be the overriding factor. That's one thing. And then you should have a proper hedge ratio. Basically, you should buy optimum quantities of your hedging instrument to make sure that the hedging is effective. So if the item is of 1 million and you buy such an instrument which is just worth 0.1 million, so you won't be able to hedge. So that's why hedging criteria means that these three conditions are met. Plus, you should always document the hedge, where you will identify what is the hedged item and what is the hedging instrument. Now, what are the accounting treatments? If I talk about fair value hedge, there is a cash flow. What is the accounting treatment of both of them? The fair value hedge says that both the item and instrument is taken to fair value at each reporting date, and the gain or loss goes via statement of profit and loss. Only one exception is there. If your item is equity instrument which is kept under fair value through OCI, then you will take it via OCI. So only exception is when it is an equity or debt instrument kept under fair value. Then what is cash flow hedge accounting treatment? The gain or loss on item and instrument goes via other comprehensive income. What you do is calculate the effective and ineffective portion. The effective portion goes via OCI and the ineffective portion goes via P&L. How do you know what is effective and ineffective portion? If the gain or loss on instrument is greater than the gain or loss on item, then that extra gain is ineffective. So basically, I've given you this example in my lectures where I talked about elder sibling and the younger sibling. So the younger sibling was brought into the world just for the entertainment of the elder one. The parents see that younger one is troubling us more. They say that, oh, this person is ineffective because the objective was not met, right? So that's what we say. The instrument, the derivative that you buy to hedge the risk of an item, if that instrument's value fluctuates more than the item's value, then that extra fluctuation is ineffective portion which goes via P, right? That's what we have in IFRS 9 completely. We have covered it, and I hope we all understand what I have. So guys, just have a quick revision of IFRS 9 before I begin with group accounts, and just have a small cup of coffee or glass of water, whatever suits you. Because after this, I'm going to begin with group accounts, and even the FR students are called back for. And we are going to start after 5 to 7 minutes of break. I'm going to start with groups. Okay. So I'll first cover basic groups, which FR students will also attend. After that, I'll cover advanced groups, which is just for SBR students. So FR students, your revision session is going to end very soon. And then for SBR students, we will stay back for IS 19, IFRS 2. Okay. These are some important standards that we will cover after advanced. So let me see you all after 5 to 7 minutes of break, and make sure till then you revise your IFRS 9. I hope I'm audible to you, and let us resume with the session. I hope I'm audible and visible to all of you, and all are back from break. So let us resume with the group accounts topic that we are supposed to do. Okay. Now, guys, in group accounts, it's very important for us to understand the basics of group accounts first. So let us first go through the basics of groups. Let's move to the another uh, page. Okay. So let's move on to the next page, which is group accounts. So when I do this topic, I need to first understand the definition of control. What is control? Control is when I have power over the investment. Power over investee. And then in this power over investee, I have not just the power, but I also have the right over variable. I have right over variable returns, and I have the ability to affect those returns. So basically, I am having a full power situation where I can not just, have the power over the subsidiary that I've purchased, but I also have any profits and losses that they make. I will have a right over that. I will have a share in that. And also that I will have the ability to affect those returns. So basically, I would be able to participate in decision making, which will ultimately impact the profit or loss of that particular company. So this is what we have as a definition of control, right? Then if we have control, we are supposed to see if we have control, then we are calling this relationship as parent and subsidiary relationship. Okay. So in case of control situation, I'm supposed to prepare group accounts. So I have to prepare group statement of profit and loss. I need to prepare group statement of financial position, and I'm supposed to prepare a group statement of cash flow as well. So let us first start with group statement of financial position. So what are the rules of making a group statement of financial position? Here we have to make 5 working notes. The working note number 1. Working note number 1 is usually the group structure where we identify who is the acquirer. Now, if you ask me who is the acquirer is the bigger company, it's the bigger entity, okay, the one who has issued shares or the one who has paid cash, the one who has the majority of board of directors, right? So it's about the voting rights. So that entity is usually the acquirer. Then once you have identified the acquirer and you've written who's the parent and the subsidiary, then comes the working note number 2, which is on net assets, fair value of net assets of the subsidiary. Now the accounting standard on consolidation says that for your subsidiary, you have to always take the subsidiary net assets at their fair value. So fair value of net assets of the subsidiary, I need to see that what were the net assets of my subsidiary at the date of acquisition, at date of acquisition versus what were the net assets of my subsidiary at reporting date. Okay, that's what I have to see. So net assets include share capital, net assets include share premium, it includes revaluation surplus, it includes your retained earnings. Then there are some adjustments to the fair value as well. Fair value adjustments like there can be some increase in the assets amount, and then fair value adjustment will also lead to some additional depreciation. So additional depreciation is an year-end adjustment, so that just impacts your reporting date column. Okay, whereas the fair value adjustment that impacts both the columns, this, and additional depreciation only impacts this one. So this is what we have in our working note number 2. So finally we get the difference between what were the net assets at the date of acquisition versus reporting date gives us the post-acquisition movement. Then what we have is our working note number 3, which basically deals with goodwill calculation. So how do you calculate your goodwill? Goodwill is calculated as fair value of consideration paid. This consideration can be in the form of cash consideration. This can be in the form of share for share exchange, right? And yeah, tax impact also comes here in the fair value adjustment part. The tax impact, DTL impact also comes here. So then it can be fair value of consideration paid, can be cash, or consideration share for share exchange can be variable consideration, which is recorded at expected value. Then you deduct, okay, so from in this you add your NCI's value. Now the NCI is either at fair value or it is recorded at cost. So if you are using, if you are using full goodwill, if you are calculating full goodwill, then you take fair value of NCI. If you are calculating partial goodwill, then you use cost of NCI. You calculate the NCI as a percentage of working note number 2, that's cost. So if you're calculating NCI as percentage of net assets of the subsidiary, then you're calculating partial goodwill. Otherwise, if you're taking NCI at its fair value, then you're calculating full goodwill. Then from this, I deduct the working note number 2, fair value of net assets of the subsidiary at date of acquisition. And finally, you get your goodwill on date of acquisition. From this, you deduct any goodwill impairment. Now, this impairment, if it is full goodwill, then it is allocated to both parent and NCI in their proportion. But if it is partial goodwill, then this impairment just belongs to the parent, right? And this gives us, when we deduct the impairment, this gives us goodwill at reporting. Okay. Then what we have is working note number 4, which is for NCI. So here we take NCI's value as per working note number 3. So if you have taken NCI at cost or have taken NCI at fair value, in that you add NCI's share in post-acquisition movement of net assets, right? So that comes from working note number 2. Basically, the NCI share in post-acquisition movement of net assets, and this from this we deduct any goodwill impairment, especially if the goodwill was full goodwill. So you deduct the goodwill impairment, and this gives you NCI at reporting date. Correct? This gives us NCI at reporting. Then finally, we have working note number 5, retained earnings. So we start with the retained earnings, parents' retained earnings. So we start with parents' retained earnings. In that, we add parents' share in post-acquisition, the retained earnings of the subsidiary. Okay. So we take parent share in post-acquisition retained earnings of the subsidiary. And from that, we deduct any goodwill impairment. If there was any unwinding of interest, we deduct that. If there was, any intra-group transaction and a PURP when parent is the seller. So PURP when parent is seller, we also deduct that. Right? Then there are many adjustment bases of the question, whatever question is there. This gives us group retained earnings at the reporting date. Okay. Now, let's understand. This was the basic of 5 working notes, which was very good for you to know. Now, let us understand the intra-transaction. What are intra-group transactions and what are their impacts. So guys, intra-group transaction, we all must know that there are some transactions between the parent and the subsidiary. And the parent and the subsidiary, we must know, are part of the same family, same group. So if there is a sale, if parent sells something, if parent is the seller, then parent has recorded the, okay. I hope I'm audible to all of you. I hope I'm audible to all of you. Okay. If parent is fine. If parent is the seller, so what happens is parent has recorded a gain. So we need to remove that gain. So what we are going to do? What we are going to do? How we are going to remove the effect of this? See, I am going to pass a journal entry where I will say group retained earnings debit and inventory credit. So basically, I'm saying remove the profit from my GRE. I will just calculate the unrealized profit. That is P1. That is the profit on unsold inventory. The inventory which is not gone out of the warehouse of the buyer. So if I've sold, parent is the seller, so parent has sold something to the subsidiary and subsidiary still has that good in the inventory, then that unsold inventory's profit is to be removed, right? So basically what we're trying to say is that this is a family where parent and subsidiary lives. This is a square. Parent has sold something to the subsidiary. If that something is still with subsidiary and it has not sold it to the third party, okay, so that profit is still there within this box and we call that profit as unrealized profit. So I need to remove my profit. The unrealized profit is to be removed. Now there are two kinds of situations. You will get markup, which is always on cost, and get margin, which is always as a percentage of selling price, right? And GRE debit, inventory credit, that's the journal entry that passed when the parent is the seller. Now, when subsidiary is the seller, what is your journal entry? When subsidiary is seller, you say working note number debit, because when subsidiary has recorded a profit, that in that NCI also has a share. So it's GRE debit, which is working note number 5, NCI debit, which is working note number 4, and inventory credit. So this GRE is and NCI can be debited both by their percentages. If I adopt a short cut, and that shortcut will be by decreasing my net assets in working note number 2. Because whatever is there in working note number 2 is also impacting working note number 5 and working note number 4 as well. So this is what I will do when subsidiary is the sell. This is how you deal with intra-group transaction, right? Then we also have associate accounting. What is associate? Associate is when you have a voting right between 20 to 50%, which is case of power to participate. This is the power to participate. Okay, this is not a normal power, it's a power to participate, and it is not an ability to affect the returns, but just to participate. So here we follow IS 28 equity method of accounting, where we show single line accounting for the associate, that what is my share of profit in associate, and I show my investment in associate in etc. This is what I do for the associate. So this is basically significant in yes. So this is what we do in our basic group accounts. Then if I talk about basic group accounts, preparation of statement of profit and loss, group statement of profit and loss. So here you all must know that if it is a mid-year acquisition, you are always time apportion the income and expenses. Always time apportion the income and expenses. So if you are creating a consolidated P&L, make sure the revenue that you are recording, if it is a mid-year acquisition, you are doing 6 by 12 of the revenue of the subsidiary. So always time apportion the income and expenses of the subsidiary, right? And then what you are supposed to do apart from it, how do you record intra-group transaction? The intra-transaction, the intra-group revenue is deducted from both revenue and purchases, which is their cost of sales, and COGS on and PURP is added to COGS. Why do you add PURP to COGS? Because when you want to remove the profit, COGS, is a cost, and you want to remove a profit. So by increasing the cost in a way, you are removing the profit. So if you want to remove the PURP, you are supposed to add it to COG. That's what you do in group statement of profit, right? Why do we time a portion in P&L and we don't do the same thing in balance sheet? Because income and expenses are of such a nature that they happen for the assets and liabilities are carried forward. They remain the same way. You've never heard asset for the year. You've always heard asset as at this date, right? So this is why we time portion in P&L, because income and expenses are always, of such nature that they are just for the year. They are monthly incomes, monthly expenses. Unlike assets, you don't have monthly assets and liabilities, right? So this is what we do in group statement of profit. And with this, we officially end the grand revision of FR. So all the students who were here from financial reporting paper, this is all that you should know from your FR perspective. I'm not saying 100%, but yes, this is what we have revised from the FR perspective, right? Now I will continue with the SPR students. All the SPR students, say a hi in the chat box. Let me see if your energy is still high or not, or we are still lacking the energy. Just say quick yes or no in the chat box. Are we still there, alive, listening to the session? Awesome. Okay, let us continue. Hi all. Let us continue with our SBR vision. So now let's move on to change in group structure, right? That's the advanced level of SBR. Change in group structure. So what we have in this is basically, when we have 0 to 10 or 0 to 20% of voting right, then we usually call that investment as IFRS 9 investment. We usually call it as IFRS 9 investment, financial asset. Then if we have between 20 to 50 percent, we call it as associate as per IS 28. And whenever our control surpasses 50%, that means 51% to 100%, then we call it as a group account situation, parent subsidiary situation, right? Now, what is change in group structure? When when we move, let's first talk about step acquisition. What is step acquisition? When an entity acquires control over another entity in bits and pieces instead of instead of a huge chunk, rather there are small chunks. So in step acquisition, for example, first situation is when we move from no control to control. So let's suppose we were already having 30% share. From 30%, we move to 80% by acquiring 50% more. So what we do is we calculate the fair value of 30% included in goodwill calculation, de-recognize the investment in associate at cost, and take the gain on fair value movement via P&L, gain or loss via P&L. You say bye to IS 28 and you say hi to goodwill. You say hi to consolidation, right? That's what you do. So you say hi to, yes. So you say hi to consolidation and say bye-bye to your IS 20. Then how do you calculate your goodwill? Goodwill is calculated in a normal way. That is fair value of consideration that you have paid. In that you add fair value of previously held interest of 30%. In that you add your NCI. From that you deduct the fair value of net assets of the subsidiary, which finally gives you the goodwill on the acquisition date. Right? This is what you do. Okay. Then when we move from control to control, what happens when we move from control to control? So let's suppose we were already having 60% of the voting rights. Now we have 80%. So it's more like there's no effect on standard. We are still consolidating like we were doing earlier. So what has happened is just our NCI has changed. So my NCI in this case has reduced. So it was 40%. Now my NCI is just 20%. So how will I calculate the reduction in NCI? I will calculate it on the basis of unitary method. I will say if, if they've given me NCI at the acquisition date, if 40% of NCI is this, then what would be 20% NCI? So what will be my journal entry? When I acquire something, I pay cash. So NCI is reducing, so NCI debit, money goes out, bank credit, and the balancing figure goes into other components of equity. This is the journal entry that you pass for control to control situation. Similarly, there is a concept of step disposal. What happens in step disposals? This is when an entity loses, when an entity, when an entity loses the control over another entity in piecemeal, is known as step disposal. Now here also we have two situations. Situation number one, when we move from control to control. So this is basically you were having 80% shares before, and now by disposing of some shares, you just have 60%. So the rule is same. This time NCI has changed, and you are going to follow the unitary method to calculate the increase in NCI. So this time the NCI has not reduced but increased. So your journal entry will be, because you are disposing of, so the money is coming in. So bank debit, NCI credit, balancing figure goes into other components of it, right? This is what you do for control to control step disposal. Then next, what do I have is when I move from, second situation is when I move from control to no control. Then what happens? Here you've lost the control. So basically you are going to calculate your profit or loss on disposal. So how can you calculate it? Happy sad rule is applied. You say when I dispose the asset, the subsidiary, I get some proceeds. So I'm happy about it. So proceeds are added. Then because I'm getting rid of my subsidiary, I may still have some interest vested in that. So it's like you broke up, but you still talk to the person you broke up with. So that is still your something which is comforting to you, that there's no contact situation. So proceeds plus fair value of the retained interest. If you have any retained interest, right, that is added. Then since you're getting rid of NCI, because you got rid of your subsidiary, that's also a positive point. NCI is an obligation on you. So if you're getting rid of it, you're happy about it. So NCI added, fair value of NCI at disposal date. So fair value of NCI at disposal date, right? And then what else you're sad about? I'm sad about less. What things we are sad about? Goodwill on date of disposal, because we don't want to lose that one. So we are sad about it, right? Then we are also sad about losing the fair value of net assets at date of disposal. So that's why we deduct that as well. We are sad about it. Right? So fair value of net assets at the date of disposal. So these are the things we are sad about. And finally, we get whether we are happy, net, or sad. So we get our profit or loss on disposal. This is the profit or loss which is reported in group accounts. In individual accounts, calculating the profit or loss is very simple. You're simply saying that, okay, you know, if I dispose my subsidiary of what are the proceeds versus what was my investment in subsidiary. That's what you do in individual accounts. But this is what you do in your group. Are we all clear on change in group structure? Yes. Now let us quickly move on to our next advanced level concept, group foreign subsidiary. Group foreign subsidiary. So what is there in group foreign subsidiary? See, we need to understand that what basically is a functional currency. Okay, what is a functional currency? Functional currency is the currency of primary economic environment, right? Primary economic environment. That is the functional currency. What is there in functional currency? We need to see the factors, primary factors, like functional currency of the amount in, currency in which you quote your prices. So currency in which you earn your revenue is the functional currency. And then the currency in which you incur your direct costs is the functional currency. The currency in which your competition is there, that is your functional currency. And if I talk about the secondary factors, there are some secondary factors like, for example, the currency in which you take loan, the currency in which you incur your indirect costs. So all these factors will determine what is your functional currency. Now, when parents' functional currency is same as subsidiaries' functional currency, it is very simple. If parent is also working in dollars and subsidiary is also working in dollars, there is no retranslation. So if there is any foreign balance, we treat it as per IS 21 individual accounts. If there is any foreign balance, we divide it between monetary items and non-monetary items. The non-monetary items are kept at historic rate. Okay, they are not touched. Whereas the monetary items, they are taken to their closing rate. And this gives rise to exchange difference. Okay, this gives rise to exchange difference. And this exchange difference is taken by a statement of profit and loss. Then if I talk about a situation where parent's functional currency is not equal to subsidiary's functional currency. Now, functional currency of the subsidiary is to be determined by the fact whether subsidiary is autonomous from the parent or not. If subsidiary is autonomous, then subsidiary will use its own factors, primary and secondary factors, to find out that what exactly is the functional currency of the subsidiary. If subsidiary is dependent on the parent, then the functional currency of the parent and subsidiary will be same. Now, in a situation where parent's functional currency and subsidiary's functional currency are not same, we are supposed to follow the rules of retranslation as per IS 21. What are the rules? All the assets and liabilities of subsidiary are retranslated in the currency of parent at closing rate, and all income and expenses at average rate. Now, this gives rise to some retranslation reserve, which basically goes via other comprehensive income. And when the foreign subsidiary is sold, this reserve is reclassified to statement of profit. So these are the rules of foreign subsidiary. Very simple. I've explained you in very simple words. I hope you all got a revision for. Okay. Next is group statement of cash flow. So this is again a very important topic, and I think more than the theory of this topic, it's more about its applications. So I hope you have solved many questions like moist, banana, which were there on group statement of cash flow. Now, in this group statement of cash flow, you need to understand certain special adjustments. So you all know that we make our cash flow statement using indirect method. We start from operating activities first, and we start from the PBT and all that stuff. So operating activity is there, then we have investing activity, and then we have our financing activity. All these things are there within the group statement of cash flow. Now, guys, in this, there are some special adjustments. This is something that you all know from your class 11th, 12th, and even your F3 and F7 paper. So I'm not going to reflect on how to prepare a cash flow statement. But there are some special adjustments in case of group accounts. So, special adjustment number 1. When you acquire a subsidiary, you should understand that money goes out. So this is an outflow in investing activity, but make sure that you know that the subsidiary is also bringing cash along with it. So that money which comes in, I have to quote the outflow in net. That means money paid to acquire subsidiary minus money brought in by subsidiary. So at net amount, I'm supposed to report the outflow in the investing activity. Same thing I have to do in case of disposal. So when I dispose, the money comes in, it's an inflow, and I have to report it at net amount. Then when I talk about various other things like dividend. So when we pay dividends, we need to prepare the T-shaped accounts of various things like NCI, associate, to find what was the dividend paid or dividend received as a balancing figure, right? So we should know how to make those T-shaped accounts. And then if I talk about your, non-current assets, for non-current assets also sometimes you have to prepare your T-shaped accounts to understand that what was the addition, cash addition or deletion from your assets. Like, you have to find out how much have you acquired or disposed during the year, which was in cash, right? Then what we have is, for example, the working capital, very important, working capital. Now, if the working capital, let's suppose inventory, what happens in cash flow is you say closing inventory minus opening inventory is equal to the movement. Okay, so if closing inventory was more and opening was less, that means your inventories have increased. So that means it's an outflow. That means you try to buy new inventory, so it's an outflow because your closing was greater than the opening. Now, during this whole calculation or equation, let's not forget that we bought a subsidiary during the year. So the closing inventory has the results of that, but the opening inventory balance in the question does not have the results of that subsidiary which we purchased during the year. So what we have to do is when we acquire or dispose a subsidiary, make sure that you adjust the opening balance. So when you acquire the subsidiary, adjust the opening balance in a way that you add it to the opening balance. So now your new equation will be closing inventory minus opening, keep opening in brackets, deduct, if it is an acquisition during the year, then you're supposed to add the results of acquired subsidiary and deduct the results of disposed subsidiary. Okay, so this is your adjusted inventory. And if I talk about the equation now, so it will be closing minus opening minus acquired plus disposed. I'm just opening the brackets. This will give you the actual cash movement. So make sure that you are adjusting your opening balance in case you have acquired or disposed a subsidiary during the year. Because obviously, if something has happened during the year, it is not reflected in the opening balances, but it is reflected in the closing balances. I have to make the closing balances comparable to the opening balances, and then only I can say this is the cash movement during the, right? This is what we have in our statement of cash flow special adjustments. I've just given you a quick brief or recap of statement of cash. Now let's come on to the IFRS 2 and IS 19, last two standards for the day, and then we just wind up. So IS 19 first, you all must know in IS 19 what we have. Employee benefits is there in IS 19. So what happens in IS 19 is IS 19, we simply talk about the employee benefit. We talk about pension. So first of all, I talk about, and the only thing which is most important is defined benefit pension scheme. Okay. So what happens in defined benefit pension scheme is that you have some, investment that you have made. So you have a pension obligation and you have a planned asset. So the pension obligation is taken to its present value since it's an obligation that you have to pay. and the planned asset is taken to its fair value. So if your obligation is greater than the asset, we call it as deficit situation. If your asset is greater than the obligation, we call it as a surplus situation. Okay. Now there are various other things like service cost. Service cost can be past service cost or current service cost, which are basically the changes in pension obligation. Okay, there are changes in pension obligation. So basically, they are added to deficits. They usually increase the service pension obligation, so they are added to deficits and deducted from service. Right. So if I talk about a proper table for it, I would say if I start from a deficit situation, the service cost is added to it. Net interest component is added to it. Then the benefits paid out have zero effect. Benefits paid out have nil effect on financial statements, neither on P&L, nor on cash flow, nor on balance sheet. Benefits paid out have zero impact on all the financial statements. Then, if I talk about contributions made into the planned asset, contributions are deducted from the deficit because they increase your asset. And then what else do you have? Then, net interest is taken into account. Benefits paid out are taken into account. Then you have your closing deficit, but this is as per the actual. Okay, this is given to you in the question, what was your closing deficit? So the balancing figure that you get is basically your remeasurement component. And again, this remeasurement component also goes via OCI, which is never reclassified, right? So this is the remeasurement component. And then you should also understand that the net interest and the service cost part goes via P&L. Contributions into the planned asset are your cash flow. They go in the statement of cash flow. These are non-cash expenses. And this remeasurement component goes via OCI, right? And then there's the concept of PASE, plan amendment, settlement, and curtailment. So basically, this is something which happens, which affects your pension obligation. So pension obligation fluctuates because of this PASE. So whenever PASE happens, you are supposed to reassess the assumptions that you have used. So you're supposed to reassess the net interest, and you're supposed to reassess the you can say your service cost as well. So you're supposed to reassess your assumptions and net interest whenever the PASE happens. And of course, you should know that if there is any gain or loss on settlement, that always goes via statement of profit. So these are the few things that you must know from your IS 19. And there's a concept of asset ceiling also. So if you have a surplus situation, you might seal it to a certain figure that, I can only show the asset up to this extent. If that surplus is exceeding that ceiling amount, then that is wiped off from, that's what it is. So basically, remeasurement component includes the asset ceiling as well. This is what is there in IS 19. Just a minute. Then what we have in IFRS 2. So in IFRS 2 share-based payment, we all must know that we have two types of share-based payment. One is equity settled share-based payment. Another is cash settled. Equity settled is when we issue shares or share options to our employees. What is cash settled share-based payment? When we issue SARs to our employees, right? That is cash settled share-based payment. Now, in equity settled share-based payment, what exactly we do is we pass a journal entry which says expense debit. We pass a journal entry which says expense debit, equity credit. And here we pass a journal entry which says that we will pay cash on the basis of how the value of my shares change. So expense debit and liability credit, right? Now expense and equity are sure that we know. So how do we calculate our expense and equity or expense and liability? For equity settled share-based payment, our formula is we use the number of employees who are going to get these share options based upon the vesting conditions. So we need to find whether they are going to meet the vesting conditions or not. So the vesting conditions that we take into account are non-market conditions, because market conditions are not to be tapped, because nobody can tap that, what will be the interest rate in future or inflation rate in future. So only the non-market conditions will impact the number of employees who will get the share-based payment. So equity share-based payment is like number of employees into number of SARs each employee will get into the fair value of SAR at grant date. Okay. Then we will just multiply this. If the vesting period is 3 years and this is the second year out of 3 years, so we will say 2 by 3. Now, this will be my equity for the second year. The movement, that means equity of year 2 minus the equity of year 1 will be my expense for that year. Expense for year 2, right? That's how you do your calculations. Now, what is the difference between cash settled and equity settled? The only difference in the formula is the formula remains the same, just because I here took fair value of SCR at grant date. This is share option here. Fair value of share option at grant date. Now here I will take fair value of SCR at reporting. So I always change the fair value at each reporting date. That is the only difference. So this point is the only difference in equity and cash settled share-based payments calculation. Rest everything remains the same. Right? So this is what we do in share-based payment. Are we all clear on share-based payment and IS 19 and the group accounts? Come on, FBR students, are we all clear on this? Yes, no, yes. Divya, if NCI at acquisition is not given, then you can take NCI as a percentage of net assets of the subsidiary plus the goodwill, if it is full. If you're asking me to repeat something, there is a feature of YouTube. You can just go to that part again, even if you're in the live session. So you can just watch that part. In control to control, when we are calculating the NCI for goodwill, then we will take last percentage of NCI. Yes, you're going to take what was the NCI just before the acquisition or just before the disposal. Okay. IFRS 11, let me just quickly cover IFRS 11 for you. If you have requested so. So IFRS 11 just talks about joint venture versus joint operation. So in joint venture, you are just having like joint venture is when two companies, they start a new company together. So this is a separate legal entity In addition to that, you also have in a joint venture, unanimous consent is a most important feature that all should agree and then we make the decision. So unanimous consent is there, and here we follow IS 28, equity method of accounting, single line accounting. Then what we have is joint operation. Joint operation is very simple. Joint operation is let's say I teach well and you edit well. So it's an operation that we do together that you just help me with the editing stuff. So it's a project that we have taken up together. It's not a business that we started together, but it's just a project. It's an operation. So you record your share of income and expenses, and the counterparty will record their share of income and expenses. That's how the IFRS 11 actually. Oh, so guys, I think we have like taken a lot of time. It's almost 3 hours now. So we will wind up this session here. And just a quick, I need to address you guys before I wind up. I know that there might be some concepts which you might feel like I don't know them, but I'm sure this revision must have helped you at least to have a focus point on each stand. Sometimes we have done one standard and then we, just quickly move to the exam kit and we forget that standard. But when we do all of them together, that helps us retain and that helps us to quickly and swiftly move from one concept to another. So that's one thing that must have helped you through this session. And yes, this was a fast track revision. So of course, I couldn't have completed each standard. So I've left on the easier ones like IS 37 and all that stuff. So that is something that you all have done in FR as well. Now come here for the further guidance on SBR. Okay. So your checklist for SBR before you sit for the paper. I hope you all have done your Super 20 questions which were shared. So I hope everyone has completed the list of Super 20 questions. Second, I hope that you all are good with pre-populated spreadsheet questions. There should be no, it's been more than a year then they are asking these pre-populated questions. So you should have a good hands-on experience on solving them. Thirdly, you should be, done with your current issues. So I have a video on current issues on my YouTube channel already. Must watch that. Then even for the technical articles, I have a playlist which covers the technical articles which are important for you for the exam in detail. So make sure you watch that as well. Then you must also do the SBR pre-mock. Now, this pre-mock is available on ACCA's channel as well. What you have to do is first you have to do it yourself. So you have to attempt this pre-mock and then later on you have to watch the debrief. Now, if you want to wait for my debrief, it will be out on 1st of December 2024. Your exam is on 4th of December. So, of course, you can wait until 1st of December. That will also give you some time to complete this. So, it's totally on to you if you want to wait or not. Otherwise, ACC has already issued the debrief. And then what we have is that you should have done at least one mock in time pressure. Because if you don't do that, then what's the point? Then you won't be able to retain anything and you will face a problem in the day of the exam. You can't go unprepared. Okay. Oh, now what we have, okay. Now what we have is another thing. When are you doing revision for the class? This was the revision only, no? That's what we have done. This is the revision. Okay, so time pressure, one mock, you all must type it out. And then what we have is, you just talk about the IFRS F1 and S. That's very important for this attempt. I really predict that coming up because it's a new thing and the examiner has a focus on it. It is the first thing in, just, ahead of the examiner. So make sure that you actually do that. So these are the 7 things, the checklist that you've done, and the one mock that all my students have given. You can expect to get your, copies as soon as they are checked. So as the ones who submitted it first, they're getting back their copies already. The ones who submitted a little later are getting back it in the same fashion. So you can expect by like 1st December, you will get all your scripts back. Okay. So this is what we have, and that's it, guys. Stay optimistic about all your, you know, how to prepare for IFRS S1 and S2. I have given a video on that as well. So it's available on YouTube. Just check that out. Okay. So that's it, guys. I hope this session was uh, helpful to all. And current issues I've covered on the video. Super 20 list is given to you. All the students who are part of my crash course or full batches, they have the video debriefs of Super 20. Current issues video is available on YouTube. Technical articles video, important technical article video is available on YouTube. SBR teamwork is available on YouTube. IFRS S1 and S2 is available. So all that I've written is available. Okay. So all the very best. May God bless you all, and may you all pass with flying colors. And I really hope and I pray that you pass and you just, rock this attempt. This is the last attempt of your this year. So let's start 2025 with a new paper. And I'm planning on to start with live classes for my March batch. So if you are a student who's planning to give their paper in March, then make sure you stay in contact, and I'll be letting out the schedule for the classes very soon. So that's it, guys. All the very best. Take care. Good night. And I hope it was a helpful session. The note